Well, good evening, everybody. This is Ron Wheeler, manager of options trading here at VectorVest, and it's my pleasure to bring you tonight's special presentation, Risk versus Reward, an Options Trading Guide. Now, to start, I want to introduce you to one of my clients, Joe. Joe says he's 61 years old and he's been investing for about 40 years, always looking for the Holy Grail. I've tried everything from stocks, options, futures, with nothing but mixed results, and he never had a real plan. Now, something changed for Joe. Since last fall, I've profited on 239 trades out of the 350 that I've placed, a 68% winning rate. My trading account started at $85,000, and in the last 10 months, I've profited over $100,000. Now think about that. That's since last fall. That includes 2020 so far. All of the craziness that we've seen this year, right? The coronavirus sell-off, the bottom, the re-rally, even the little bit of volatility we've had here recently, that's including all of that, and that's really great results. Now, he also continued, what's more exciting is that since my knowledge and experience have grown in regard to taking really good risk to reward trades, I've profited over $50,000 in the last 6 weeks, and his success rate has improved to 78%. Now, what I really want to focus on in that statement is taking really good risk to reward trades. Now, how does Joe do it? First off, Joe is an options seller. In order to get this level of success, you have to be an option seller first. Now, to be an option seller and get to that level of success and that really good risk reward that Joe is talking about, we're going to break this down into 3 key principles of what Joe does to achieve the level of success that he has gotten so far. Now, if you recall, Joe mentioned that he had achieved a 68% probability over the first part of 2020 and the last part of 2019. And what he also said is he was able to elevate that even higher to 78% in the last 6 weeks. Now, how does he do that? How does he base first that level of success? Well, step number 1, or key principle number 1, is to understand probability. Now, what you're seeing on your screen is a graph with something called a probability envelope. Now, it's not important to understand how the probability envelope works. This is something that most option traders are familiar with. If you're not, I'll kind of explain how it works. What this envelope shows you is where this stock, and it doesn't matter what stock it is, it applies to every stock, it has its own calculation. What this envelope shows you is where in the future, based off the historic movement of the stock, you have the best chance to be in the future. So to give you some percentages, you don't have to remember this, we'll talk a little bit more about this as we go through the rest of tonight's presentation. This stock, it has a 68% chance, of being inside of this blue cone into the future. Now, when we get outside that, this stock only has a 32% chance of being up here into this orange and this red area. Think about that. Very low probability that will be down here. Very low probability that will be up here. And in fact, into this red area, it really gets down to only about a 1% chance that this stock will be in that price range as we go into the future. So I want you to remember the percentages. Don't remember the exact percentages, it's not important. But remember, this is based on a percentage. How likely will the stock be in this price range, or how likely will it not be at that price range? And this is important because to be successful, you need to enter trades that give you a high probability of winning. Even if you're wrong on direction, it goes beyond analysis. It goes beyond graph patterns. What we want to do is use that probability to our advantage and set the trade up for success first. Now, how do we do it? Well, first off, let's take an example of a really good stock, TMO, Thermo Fisher. Take a look at the graph pattern. It looks great, right? Rising price, rising EPS, strong RT. This is a stock that anybody could get behind to be bullish. So let's work with Thermo Fisher and take a look at how we can set up a trade that has a high degree of probability. Now, since we're dealing with options, I'll switch over to our VectorVest Options Pro software and let's take a look at Thermo Fisher. Now, I want you to think about what would happen if we were to go out right at the current price and buy 100 shares. In that particular trade, you ultimately have a 50-50 chance of success. Now, I'm removing any other type of analysis from this. I'm just saying at a base probability, when you buy or sell a stock, it gives you a 50-50 chance of success. Now, what we're going to do is use the principles that we talked about of probability to pick where this stock is most likely to not be in the future. Now, our underlying analysis is we believe the stock will increase in price. So what I do is I choose a price underneath the current market to base a probability trade. Now, for instance, if I go down to a price of $460, what that does is it allows me to place a trade where I could make money if the stock goes up, I could make money if the stock goes sideways, and now I can make money as long as the stock stays above $460. Now, where a lot of people go wrong when they're choosing probability is they choose these very, very, very low probability prices. So in some cases, they may go down even as low as, let's say, $400. Because really, what could go wrong, right? This is a very bullish stock that hasn't been at $400 a share since July. Why wouldn't I want to be bullish and choose a price of $400? That way, hey, the stock goes up, I make money. If it goes sideways, I make money. If it goes down, wow, I have all of this room to $400. What are the chances of Thermo Fisher in the next month and a half actually getting to $400? Let's take a look. I'm going to go over to an option chain. Now, I'm going to show you a percentage. It's called ITM. It stands for in the money. And what this percentage is, it's the percentage chance that Thermo Fisher will hit that price by the November 20th options expiration date. Now, if I go down to $400 right here, if I look at that, that option only has a 0.5% chance of being touched. That's incredible. I can take a trade that gives me a 99% probability of success. Wow. But that may not be a good idea. I showed you the 460 option, which gives me about a 25% chance of being touched. That equates to a 75% probability. Now, those percentages are based exactly what you saw off of that probability envelope and those cones that I showed you. That's where those percentages come from. The beauty of being an option seller is that we can select our trades and set them up with a probability already built in using the historic movement of the market. Now, in a bullish market like Thermo Fisher, what you would do is you would sell a put. We sell puts in bullish markets because as an option seller, we're selling it and collecting premium. As the stock goes up, the premium that you sold it for will start to decline. Now, for example, if I sold this $460 option, I can collect $835. Now, as the stock goes up in price, like we hope it will, that option premium declines. It goes down to $8, $7, $6, $5, etc. It's going to decline. And then as an options trader, what I can do is I can go out to the market and find somebody to take that position off my hands for much less price, and I can secure a profit. So in a bullish market, we are going to sell a low probability put. So the first thing that Joe does is he selects good quality stock candidates and sells options with a base 60% chance or better of success. Now, that's part one. Step number two is the meat of the presentation. understanding risk versus reward. And I love this imagery. She really wants to go swimming, but if you take a look at that sign, sharks are sighted. Enter water at your own risk. She's got her hands on her hips. She's probably thinking, all right, I really want to go swimming, but is it worth it to me today? Well, that's what she's going to have to talk about or think about in her head. Is it worth the risk? Now, in trading, to be successful, you need to have a balance of probability, but you also need to consider that risk to reward. One of the biggest downfalls and killers of option selling is traders that go out there, and I like to call it being seduced by probability. I have a chance to be 99% right on this trade, so I'm going to do it. But then that one time that trade goes against them, all of their gains are wiped out. So let's talk about this. How do we determine and how do we look at what is the appropriate risk to reward ratio as an option seller? So what I want to do is I want to go back to that example of Thermo Fisher. Now I'm going to start with that $400 option, which looks so good, right? $400 option, it had a 99.5% chance of success. Let's take a look at that. I'm going to go ahead and choose to sell a $400 put on Thermo Fisher. Now, what you're looking at is a risk graph. This risk graph will tell you what the profits or losses of your position will be as time goes on and as the stock price moves. So, what you're looking at is a dashed line. If Thermo Fisher were to rally, follow that dashed line up, and it goes to $500, this trade would be profitable by about $61. Now, there's a couple problems with this. Number one, this is considered a naked option sell. Not a lot of traders can do this. It requires a lot of capital. So the first thing that we do, and if you look over on the right-hand side, look at that profit of $130 and look at that risk of over $39,000. Now, to be completely fair, the stock would have to go to zero for you to lose that much money. But even so, you can see it's a very, very, very high risk ratio here, okay? So the first thing that we do to make this trade less risk is we put it into a spread. I will sell a $400 put and then give myself some disaster insurance. Now, the worst thing that can happen to you if you sell a $400 put is you may be put to the stock, right? You could have the chance to buy the stock at $400. Now, understand one thing about tonight. What we are doing is solely options. This is not about selling a put to try to buy the stock later on. That's a completely different trading methodology. This is about using options for trading income, okay? Now, I never want to own the stock. So the worst thing that could happen is that maybe this stock has some sort of catastrophic problem and it opens up at $200 a share. Well, when you're short that $400 put, there is a chance that you could be assigned the stock at $400. Well, if it's trading at $200, that's bad. So what we do is we sell a put and then we simultaneously purchase an insurance put. So in this case, I'll buy a $390 put. Now what that does is it gives me the right to sell the stock. So if the off chance was I was put to the stock at $400, I can turn around and sell it to somebody else for $390. Now I want you to watch what that does to my risk. That risk is now reduced down to $987. Now, take a look at this trade. Your profit potential is $12. Your risk is still $987. Now, think about that. This option, sure, it only has a 0.5% chance of finishing in the money, right? But I want you to think about that. Let's say, and I know you can't have a half a trade winner, but let's extrapolate this data out. What were to happen if you were to take this trade, you took it 10 times, and you had 9.5 winners. Out of those 9.5 winners, you made $12.50. You would profit $118.75. That one losing trade that went against you, you were going to lose. And again, I know you can't do half trade increments, but I'm just trying to keep it to the right numbers. You would lose $493. you would wipe out every one of your wins, including some others as well. This is an example of a trade that probability is awesome, but it's not workable. It's not something that we can do. Now, what we do is we set a base probability of 60%. So if I were to go into this and instead, how about we choose my $460 option and then purchase our insurance at $450. Now, what you're going to see is a credit of $225 and a risk of $775. Now, it's two reasons that the probability is important. Number one, because we want to set a base 60% probability. Now, the second reason that probability is going to be important is because we're going to use that as a stop price. So I want you to go back to the graph of Thermo Fisher. We chose a price of $460. Now, if you were to buy 100 shares of Thermo Fisher, you would not just buy this stock and let it go to zero, right? You're going to put in a protective stop. As an option seller, we will do the same. We will stay in Thermo Fisher until we hit a profit target of 50% or Thermo Fisher were to drop below $460. Now, what does that do as far as risk to reward goes? Now, I take profits on these trades at 50%. This is what we taught Joe. This trade has a maximum profit of $225. What we do is we take profits at $112.50. Now, why do we do that? We do it for a couple reasons. Number one, in order for this trade to reach profits, we really only have to rally to about $400 and maybe $98. In order to achieve all 100% of the profits, the stock would have to go up another $35 to $40 a share. So we can make the most money with the least amount of room. Now, what we're also going to do is we will exit this trade if the stock were to drop below $460. Now, at $460, we are projected to lose $225. Now, that may sound bad, right? But think about this again. Extrapolate the data. This trade has a 75% chance of success. That means if I extrapolate this out to 10 trades, $112 times 7.5 winners, I would make on those trades $843. On the two losing trades at 225, I would lose 562. This is a trade that has a much better risk to reward ratio. Now, remember, we start this with a base of 60%. This trade actually has 75% and looks very, very nice. We could actually, if we wanted to, maybe even increase that. Now, the 470 option has a 35% chance. That gives us a 65% chance of success. My profit target now is 150. My risk, if the stock were to go below 470, is only about $150. This trade has a 65% chance of success with a 1-to-1 risk to reward. So it's all about extrapolating that data out, making sure that if your probability is right, you're not going to have a losing proposition. Don't be seduced by probability. Work that trade out and make sure it has a good probability, but then also a workable risk to reward ratio. That's what Joe does. Now again, going back to the history that Joe had in the last 6 weeks, he talked about boosting his percentage of accuracy to over 78%. Well, I just showed you a methodology that starts with a base 60%. How do we get to that 70+% success rate that Joe saw? Well, I like to call this adding layers to the probability cake. Now, to be successful, you add layers to probability. It's not just enough to look at an option that has a base 60% chance of success. We want to put that option into a system that helps us layer or stack probability. Now, what I showed you today was the base 60% option probability, but most importantly, also assessing your risk reward, because probability means nothing if you have one losing trade that blows out a lot of winners. So to increase that probability, to get those 70% or better rates of success, we also need to add market direction. As an income trader, we only trade in the direction of the overall market. If the market's trending up, we do bullish trades. If the market's trending down, we do bearish trades. Then we have to look at stocks. We look for things like Thermo Fisher that has rising prices with rising EPS, a great RT. In a down market, we look for falling EPS, low RTs, weak stocks. We then have to look at the graph itself. I like to take a look at longer term and then both shorter term price trend. When you look at the graph of a stock, that's the DNA. That will help you determine good trending information. And then the final thing that I like to do is I only like to trade in the direction of the daily trend. That means I buy rising stocks on rising days. I do not go bullish in a stock unless the stock is actually up that day. I do not do a bullish trade when the stock is down. I do not do a bearish trade when the stock is up. I only trade in the direction of the daily trend. That is your last line of defense as an investor, making sure that you have direction right. Now, what are some action steps? How do we implement what Joe was able to do, and what's the easiest and fastest way to get this going in your own portfolio? Now again, as a reminder, he was the gentleman, Joe, who tried a bunch of different things with mixed results, and he never had a real plan. But he made that dramatic shift last fall and began a series of 350 trades, which helped him profit over $100,000. Now, Joe followed the advice of our founder, Dr. Bart DeLito, and he learned to trade options the right way. Now, the best course available anywhere is our Options Paycheck course. In a matter of 7 weeks, you'll have a complete income system set up in your portfolio using options just like Joe. Now, after taking the course he said, this is the first time I have a written plan and stuck to it. I'm charged up every day for the market, knowing that my trading is like me being the house at the casino, and my profits will continue to flow. It's great to know that I can retire right now if I want and rely strictly on my trading for annual income. I cannot thank you enough for this class and what it can do for people. Now, registration for the Options Paycheck class is currently open. You can go to www.optionspaycheck.com for more information and register before it closes. I want to thank you all again for watching our special presentation tonight, and I wish you continued success in your investing.
Yeah.